The worst stock market performance since 1970.
Do you ever feel like you're late to the party? Like every time there's a sniff of something good, you hear about it and then just get there too late. While I'm sat here reading these headlines about the worst start in 50 years, I can't help but feel sorry for new investors. All excited to see the party pumping, you got yourself all dressed up in your best outfit, didn't you? Grabbed yourself a 4-pack and a tub of hummus out the fridge. You didn't want to show up empty-handed, but when you got there, you were greeted by another type of dip.
We are not buying this dip.
So today I want to explore this claim of the worst start in 50 years and just get under the skin of it a little bit. Try and figure out what we can do about it. So if you're feeling like the last to be picked, underappreciated, if you're always the bridesmaid, never the bride, then this one's for you.
I don't know what to do about the depression and the inflation and the Russians and the crime in the street. All I know is that first, you've got to get mad.
That clip was from a movie called Network. In that scene, actor Peter Finch goes on this epic rant where he bemoans the state of the economy and encourages people to
Get mad.
What's crazy about this clip, as I'm sure you'll agree, is the striking similarities that it shares with today. The film was released 46 years ago and was made right about the time these articles are saying the last worst period was for the stock market. Between 1973 and 1974, the S&P 500, which is the largest 500 or so companies in America, fell 40% in value.
It's a depression.
An energy crisis, high inflation, and a devaluing of the dollar are just a few ways that the economic situation of the 70s mirrored that of today. Minus 40% was the final score back then, so just how bad are things today?
I don't have to tell you things are bad.
Yeah, I mean, it's pretty bad. Look, the astute of you are going to be sat there thinking, why has this guy got lightsabers on his walls? And you might also be pondering the fact that if in the 70s the market's dropped by 40%, that's well more than we've seen so far in 2022. And you would be right. But the thing that sets 2022 apart is the speed of the decline so far. In the first 10 months of 1973, the markets fell 10%, enough to make anyone question their decision to come to the party. But then 2022 comes along, says, "Hold my beer, mate," and drops in with a huge 25% down year to date. $10 trillion up in smoke. And we ain't done yet. A whole host of factors are working against the market at the moment, making the prognosis look rather grim. As well as that, there's just nowhere to hide for investors at the minute. In a rare set of circumstances, both bonds and stocks are being decimated, which means the world's most popular portfolio, the 60-40 allocation, designed to help you weather any storms, looks like it's pedaling backwards at the minute.
It's like peddling in hummus.
Like the hummus jokes, the situation's pretty bad. But you already knew that, didn't you? So what, as investors, should we do about it? I mean, this is the worst start to the market in 50 years. Surely if there was ever a time that you were going to do something, now is the time you need to take action. But before we get into that, let me tell you about today's video sponsor, NordVPN. Let me get the cat. Cobweb. We all know that NordVPN is a world-class VPN service that will help you protect your privacy while you browse online. But did you know that Nord also offer a load of other features as part of the subscription? Where's the cat? Their new threatware protection feature has built-in malware protection, tracker blocker, and an ad blocker.
Cobweb?
So when you're downloading stuff off the internet, Nord will automatically scan the download to ensure there's no malware. And when you're browsing the web, Nord is going to block any pop-up ads. They also have a really good dark web monitor that will notify you anytime your details or passwords are leaked on the dark web. Cobweb! I've actually benefited from that side of the service recently as it notified me one of my old passwords had been leaked online. So check out NordVPN using the link in the description, or I'll pin one in the top comments for you. If you use that link, they have a great deal on at the minute where you get 4 additional months for free on a 2-year plan, plus there's a 30-day money-back guarantee. Yo, there you are. What are you doing in here? I need your help making an advert if that's okay. Nice. If there's one area of investing that I find more fascinating than the rest, it's the psychology of it all. Our minds make us bad investors. Cognitive dissonance is the discomfort you feel when your behaviour does not align with your values or beliefs. You want to be fit and eat healthy, but you just can't put down the breadsticks and hummus. That guilty feeling you get whenever you eat it is cognitive dissonance. When it comes to investing, cognitive dissonance can make us make bad investing decisions. Like right now. Investors new and old feel discomfort because the notion of average returns has gone out the window in the face of the worst start to investing in 50 years. You signed up for a 10% average return and instead it feels like the markets are giving. There's been countless studies and papers on how to address this and how to act at times like this. But I like this one. Does feedback on personal investment success help? The TLDR on this paper is essentially that within the professional investing world, the smart money world, they get feedback on their investment decisions. So if you work at an investment bank, you're surrounded by data, professionals, systems, and if you balls up, they're going to turn around and go, This is what you did wrong and this is how to fix it going forwards. As dumb money, or retail investors as they call us, either works, we don't get that feedback. The study comments on the fact that only 1 out of 120 banks in Germany that allow people to invest give feedback on a regular basis. So Linda, Stefan and Sophie, who wrote this paper, did give feedback. They took 1,500 investors and at the end of each year, they sent them a report saying, this is how you did and this is what we would do to fix it going forwards. And guess what? It made them better investors. I'll quote the paper directly. We find that after receiving reports, investors trade less, diversify more, and have a higher risk-adjusted performance relative to the control group. And these effects become stronger over time. So, how do we get this feedback that we need from the market? Like, I'm not offering to sit here and grade your portfolios like some teacher, because let's face it, I'm just as clueless as to what the hell's going on as the rest of us. But in the words of William Wordsworth, life is divided into 3 terms: that which was, which is, and which will be. Let's learn from the past to profit by the present. Profit in the present is definitely the goal here. So let's learn from life's greatest teacher, the past. Is it just me, or was that a really long-winded way of saying let's take a look at some past results to see if we can get some answers here?
He's wasting your time.
In this section, I'm going to be quoting the work from an Evelyn Trias from Seeking Alpha, and the full article is linked below for you. It's called Getting in at the Worst Time and Still Emerging with the Best Investment. If you wanted an example of conflicting inputs that could lead to cognitive dissonance, that title has it all. Starting at the worst time, but ending in the best place. So the article basically looks at the 3 biggest, most recent crashes we've had. The tech bubble, which popped in 1999, the financial crisis, which tore investors a new one from April 2007, and then the most recent, the COVID crash, which lasted a whole 2 months. Evelyn then applies 3 investment strategies to each period of time and see who does the best. What I'll do is I'll explain each investment strategy to you briefly, and then I'll give you the overall findings, like the headline figures and results, rather than going through each one individually, as that'll be a lot of data for this video. Like I said, I've linked the article below, it's well worth a read. Personal investment strategy number 1 invests $100 at the peak of the market and then just invests $100 every month consistently until now. So they get started at the worst possible time. Before someone accuses me of high treason in the comments, I'm saying dollars because the article is literally written in dollars. And let's face it, it's all worth the same anyway nowadays. Personal investment strategy number 2 saves the 100 quid from the top of the market and waits till the bottom of the market. They then start investing their $100 every month from there and saves that pot of cash. So the best way to think about this is in the COVID crash, that individual would have waited for 2 months to get started and saved up their $100 each month into cash, and they would have had a pot of $200 waiting there. They wouldn't have then thrown that into the market at the point that the market hit the bottom, assuming they were able to call that. They would have then just started investing $100 a month, and their end result is the result of investing from the best possible time to start, $100 each month until now, plus the $200 in cash that they saved, that they didn't invest because they waited. Finally, personal investment strategy number 3 is just a straight up genius. They also saved $100 waiting for the best time to invest, but when that time came around, they then dumped all of that money into the market and then continually invest $100 a month going forwards. So the interesting thing is the outcome, or who performed the best, is the exact same across all 3 time periods, across all 3 crashes. The only difference is the total amount they have at the end because of the amounts of time they will have invested for. I'll read her conclusions word for word. Based on history, it pays, quite literally, to begin investing as soon as possible and to keep investing in the market as often as possible. Even in the worst case scenario, when the markets crash right before you start to invest, history shows that investing early, you do 10.3% better on average than you would have if you saved your money and only started to invest at the lowest month of the past 3 big crashes. So the person who sat it out and waited performed on average 10.3% worse than the person who just got involved even though they started at the worst possible month. But what about that person that was a bit of a genius? On the other hand, flawless market timing in scenario 3 only earns 3.1% more money than the investor who starts investing right before the crash. The payoff in this example for the person that's perfect isn't even that much better than the person who invested at the worst possible time. And that assumes that you have the ability to flawlessly time the market and then the metal, the brass, to pile your money in when you think you've hit the bottom. I'm just going to put it out there, you don't. No one has the ability to consistently time the bottom of the market. The reason this example works as feedback is we can look back retrospectively and hypothetically go, if someone bought here, if someone bought there.
No, we don't try to pick bottoms, or we don't have an opinion about whether the stock market's going to go tomorrow or next week or next month. So to sit around and not do something that's sensible because you think there will be something even more attractive, that's just not our approach to it.
The desire to act and do something based on headlines like this will likely cost you money unless you are literally an investing genius. Really, that's the point of this video. You see, there are two types of investors. There are long-term investors who are looking to build wealth over an extended period of time, and then you have speculators who wish to make money from the market short-term. The media with headlines like this are catering to short-term speculators. Because let's be honest, those types of headlines are great for grabbing attention. CNBC and the likes of are going to run out of things to say if their message is, yeah, things are bad at the minute, but long-term consistent investing has always proved to be successful for investors. I mean, it doesn't bode well for my channel, does it? But I won't worry about me. I started talking about 30 odd years ago and I haven't stopped since, so I should be good. But as long-term investors, we mistake this chatter and noise for feedback, as it's the only noise we get, making it sound like this is the worst it's ever been, it's an awful time to invest, and you should be steering well clear of the market. This is why I showed you that clip at the start, because it serves as a reminder, as feedback from the past. It tells us that the markets have seen it all before. If you're still not convinced and you feel like you need more of a therapy session, then you need to watch this video here, in which I outline how I'm approaching this whole market mess. So yeah, sit down, get comfy, and let's get
They got problems on problems on problems on problems on problems on problems. I solve them. I run through the money, the pressure be calling. Left on my blessings, I feel like I'm